Let me ask you something. When you click buy or sell, who is on the other side of your trade? You think you are trading the market? You think you are battling banks? You think you are competing with hedge funds? But before all that, there is someone else involved. Your broker. And here is the uncomfortable truth. Your broker is not a charity. Your broker is not your friend. Your broker is not emotionally invested in your success. Your broker is a business. And today we are going to break down calmly, intelligently, and without conspiracy exactly how forex brokers make money. Not from rumors, not from TikTok theories, but from structure. Because once you understand the structure, you stop trading emotionally. You start trading professionally. Welcome to SmartRise TV, where we succeed together. 1. The spread, which is the invisible tax. Let's begin with the simplest income stream, the spread. Every time you open a trade, you start negative. Why? Because there are two prices, the bid and the ask price. On a pair like Euro USD, you might see 1.1000 ask price, bid price, and 1.1002 ask price. That 2 pip difference, that's the broker's first paycheck. It doesn't matter if you win, if you lose, if you close in 3 seconds, they already end it. And here is what most retail traders never calculate. If you trade 10 times per day and the spread is 2 pips, you are constantly paying transaction costs. Now imagine 10,000 traders doing the same. That is millions in predictable revenue. The spread is not evil, it's business. But here is the psychological trap. When traders overtrade, the brokers earn more, not because they hunted you, but because you are active. Volume equals revenue. That's the first pillar. Number 2, the commission. Now let's talk about transparent brokers. You have probably heard of IC Markets, Pepperstone, Xness, and a whole lot of others. These brokers advertise raw spreads through ECN, direct market access, and often they are legitimate, but they charge commission. Example, $7 per lot round turn. Let's break down calmly. If 1,000 traders each trade 5 lots daily, even if they all win, the broker still makes money because commission is volume based. The broker does not need you to lose, they need you to trade. And this changes your mindset. The business model is built on activity, not on your profit. The third part is this. There's what we call A book versus B book. Now, we enter the controversial territory. There are generally 2 execution models. We have A book and B book. A book, your trade is passed to liquidity providers, banks, institutions, interbank market. The broker earns spread or commission. They do not take the opposite side. Now, the B book, this is where many traders panic. In the B book model, the broker internalizes your trade, meaning if you lose, they gain. If you win, they pay you. Now pause. Does that mean scam? Not automatically. Why? Because statistics show that between 70% and 85% of retail traders lose money long term. If you run a business and statistically most clients lose, internalizing risk can be profitable. It becomes a probability game, not personal manipulation. But here is a deeper layer. Smart brokers don't be-book everyone. They analyze behavior. Consistent profitable traders, they may a-book you. Emotional gambler, they be-book you. This is risk management. Just like banks manage risk, the market is not emotional. It is mathematical. The fourth part is swaps and overnight fees. This is another income stream for the brokers. The swap, or also called rollover. When you hold a trade overnight, you either pay interest or receive interest based on interest rate differences between currencies. Example, Holding USD against low interest currency may earn positive swap, but most retail traders pay swap more than they earn. And here is the subtle psychology. Swing traders who hold for weeks pay accumulated swaps. Another income stream, not dramatic but consistent. And consistency builds brokers' revenue. Part 5 is news, slippage, and liquidity. During major events like non-farm payrolls, consumer price index, liquidity disappears, spreads widens, slippage increases. Is that always manipulation? No. Sometimes it's simply market mechanics. But during volatility, transaction costs increase, which increases broker revenue. Again, activity, movement, emotion. The more chaotic the trader, the more profitable the structure. So the final part, which is the philosophical truth that we must know. Now let's count down everything. Is your broker your enemy? No. Is your broker your partner? Also no. They are infrastructure. Like a toll gate on a highway, they end when you pass. Whether you reach your destination or crash your car, the toll has been collected or has been paid. And this is the maturity shift. Stop blaming brokers for losses. Start managing risk, frequency, leverage, emotional impulses. Because here is the irony. When you trade less, when you trade precisely, when you trade like a sniper, you reduce their income and increase yours. That's the paradox. The professional trader becomes boring. The amateur trader becomes profitable for the broker. So the real question isn't how do brokers make money? The real question is, are you trading like their ideal customer or are you trading like a professional? This is SmartRise TV. Succeeding together.